Good afternoon, everyone, and a very warm welcome to our STANLIB webinar series. Thank you for spending the next hour with us. I'm Tracy Kutzer, and I head up the institutional distribution team at STANLIB. Joining me on today's webinar is Wehmeyer Ferreira, the co-head of STANLIB Index Investments. Hi, Wehmeyer. And Sebastian, portfolio manager within our Index Investments team. So just to recap, for those that may not be familiar with the team, STANLIB Index Investments is an 8-person specialist investment team at STANLIB that focuses purely on running index and quantitative investment strategies for our clients. The team now manages over 56 billion rands of assets across a wide range of strategies, including vanilla local and offshore tracking funds, right the way across to our range of multi-factor funds. And honestly, I can say the team includes some of the brightest minds I've worked with, and they're all extremely passionate about what they do. And I really hope this comes through in today's discussion. So the topic of value investing has certainly been one that has dominated the investment headlines over the last year. When do you get in? Is it too late to get in? How long will the cycle last? And I'm happy to say that we have portfolio managers like Anne that will help us unpack this today. And very grateful that we're not relying on me to be making those kinds of decisions. So without taking up any more of your time, I'm going to hand over to Anne, who'll summarize the views and findings of her article that led to the topic of today's discussion. And after that, Wehmeyer will unpack this in a little bit more detail with Anne in a Q&A session. But we'd also love to hear from you. So please post your questions in the chat, and I'll pose these to Anne and Wehmeyer towards the end. So thanks, everyone. I hope you enjoy the session. Over to you, Anne. Thank you.
Thanks, Tracy, for such a generous introduction. So hopefully I'll be able to wrap up our views or my views on can value relive its glory days in 15 to 20 minutes, but let's just see how it goes. So this has been the story. Value has underperformed growth since the global financial crisis. Now, if you look at this slide, what's very clear visually is that value has underperformed growth since GFC quite consistently and quite severely. But at the same time, it's important to remember the glory days of value, where value had outperformed growth for a couple of years preceding the 2008 crisis. So why are we here today? Well, very recently in the short term, we've seen value outperform growth and the market. And then this has sparked a lot of investor debate. Now, I would say that the debate can be summarized into two components. The first is the short-term rally in value going to continue in the short term? So will value in the short term continue to outperform growth? The second part is this a more structural or secular rotation in the long term out of growth into value and the return of value's glory days? So that's the part, both parts actually, are parts of what we want to discuss in this webinar. We'll share our views on the short-term aspect as well as this long-term aspect of this rotation. So why has value been performing recently, or outperforming growth and outperforming the market? So from the lows of the COVID crisis, we saw economies reopen, we saw massive policy support, we saw vaccine breakthroughs, vaccine rollouts, and this all resulted in a recovery trade in favor of value companies, which were the COVID losers, from growth companies, which were the COVID winners. So there's been a clear thirst for risk in this environment, and value has benefited in that environment. So what do we think? Do we think in the short term value will continue to rally and continue to outperform growth? We think yes, in the short term, there's enough merits for value to continue to perform in the short term. And this is because value performs best in the recovery environment. So on the slide, what I've just summarized is the different macroeconomic environments and the style or the type of investing that works best in each of these environments. And what you can see is value performs best in the recovery environment. So why do we think this recovery environment is here to stay with us for some time at least? Well, this is based on our purely data-driven quantitative macro indicator, still forecasting a recovery. So a couple of things to note about this indicator. It's, as I mentioned, purely quantitative, purely data-driven, a systematic approach in determining what is the environment saying about what is going to happen in the future in terms of, is the macroeconomic environment improving, i.e. recovery, i.e. green bubbles, or is it contracting, contraction, or is it slowing, the yellow bubbles, or expanding, the blue bubbles? What is also important to note is that the raw forecast from this indicator started flagging a recovery from May last year, and it's been quite a persistent call from the macro indicator. So this is the same macro indicator with just a 2-month rule applied. And what you see is when you apply the 2-month rule, and the 2-month rule is just saying that you need to have 2 consecutive months of the same forecast for it to be a valid forecast. So the raw forecast said from May, we're going into recovery, but now when you apply the 2-month rule, it's from June. What's also interesting to note is when in history did we see a lot of green bubbles together, so consecutive green bubbles. And that was most recently in the 2016, the Trump trade, Trump bump, and then 2009 coming out of the global financial crisis. This indicator is used in our funds to tilt not time factors, but I'll just park that for now. So I've stated that value performs best in a recovery phase, and this is the evidence that backs up that statement. So all we've done here is taken the average performance of the different styles, and we've just focused in on a few of the styles and looked at their average performance in the different macroeconomic phases. And what you clearly see is the purple represented by value. Value clearly outperforms or does its best in a recovery environment. It's really at the expense of all other types of investing. So growth, quality, price momentum, all sold off in favor of the risky value companies. What's also interesting to note is that in other macroeconomic environments, it tends to lag, and the growth, quality, price momentum kind of styles tend to have a more balanced profile. So again, just to summarize, this shows the evidence that recoveries value performs, and it's really a value versus everything else kind of story that comes out in recoveries. So what else is working for value in the short term? So when you think about the short term kind of commentary out there in the market, it can be summarized into 2 things that are working for value, at least in the short term. So there's this value is an inflation hedger over growth. So there's some short-term prospects for value because of its inflation hedging ability. The second is the valuation differential. So the valuation of value companies is at historical gaps to the growth counterparts. So we'll try to unpack each of these and just see if there is merit in these claims for the short-term aspect of value. When we look at the data or the analysis of whether value does hedge inflation fears, realized inflation as well as inflation expectations, we do see merit in this claim. We do see that value tends to outperform the market when inflation is rising, and growth tends to underperform the market when inflation is rising. And this is whether you use consumer, producer, or inflation expectations proxied by break-evens, you see a similar story. So value is able to provide an inflation hedge over growth. And especially with inflation being such a fear in this market and a worry, value does show prospects of that. The second one is the valuation differential. And we think when you look at the valuation differential, this is more a US than a South Africa story. So on this slide, very simply, what we've looked at is the valuation of value versus the valuation of growth. On the left is for the US market, and on the right is for the South African market. We've used a couple of descriptors for that, so PEs, etc. And then we've looked in a standardized manner, how has this progressed? So on the left, you clearly see the story that value is looking cheap relative to growth on a US perspective. But when you look at it in South Africa, it's less of an argument in favor of value for a valuation aspect. So to summarize, we think in the short term, there is legs to the value trade. And that's because we're seeing a recovery environment based on our macro indicator still persisting for some time. And we're seeing the fears of inflation value being able to hedge those fears. So it will benefit from fears of inflation going up. The risk to the short-term view is if there's any hiccups in any of the things that have resulted in this recovery trade. So, for example, with vaccine rollouts, I mean, those are components that brought up this recovery trade. If there's any hiccups on the rollout of vaccines, if something has to fundamentally change from the policy support side, anything that kind of shifts this recovery trade, then that is a risk to the short term. And in our world, how that plays out is the macro indicator would fall back into a contraction. There's also a risk on the upside that this recovery trade or this recovery environment gets a lot of energy behind it, and the cycle matures to an expansionary environment where other styles like momentum and growth tend to perform well in those environments. But all in all, we think in the short term, there is value in going into value over growth because we see the recovery environment persisting at least in the short term and inflation fears being supportive of value in the short term. Now, the second part of the debate, as I mentioned at the beginning, has been, is this a more longer term secular rotation out of growth companies into value companies? And before we jump into our view on that, I thought it was important just to understand why has value underperformed growth since the global financial crisis. If you look at commentary surrounding this, it's been, others have said it's because of the low interest rates since the global financial crisis. And the other component has been that it's because of the sectoral differences between the value basket and the growth basket. So if you think from a US perspective, this is the whole tech versus financials debate. So we again want to look at what does the evidence actually say? Does it actually back up these two arguments for why value has underperformed since the global financial crisis? So the first one was very easy for me because I didn't have to do any of the work. The AQR team, a very well-respected team, very well-respected by our team, did a thorough global analysis on value and interest rates and whether rates are to blame for value storms. And what they saw is there's actually no evidence that links in the long term the value premium to the level of interest rates. Slope changes also didn't make a big difference or a big determinant of the drawdowns. And they concluded the rate environment had very little to do with values prospects. And any change in that environment wouldn't necessitate a rotation in the long term out of growth into value. And on the slide, we just took one of the more simpler graphs from this paper that AQR, the team that's head up by Cliff Asness, and looked at the major drawdowns that value has experienced. And the most recent one being from 2010 to 2019. And basically what it says is a big portion of that is actually not explained by the slope. They go through a very thorough analysis. They look at very different value definitions, different slopes, different geographies. And they say, okay, there's some merit maybe in slope, but then when you investigate further, actually a large component of even the slope doesn't explain the downfall of value. So this is what makes me already doubt it's not the interest rate in the long term that has explained why value has underperformed growth. The second part is the sectoral differences. And again, if you have to understand that, you think everyone's condensed this growth versus value debate into a tech versus financials debate, US-based. In our market right now, it's more consumer discretionary versus financials, maybe resources kind of argument. And I think this is a very powerful slide. This basically looks at the performance of value over growth in both the South African market as well as the US market when you neutralize or you control for sector risk. So what does that mean? It means that, for example, on the left-hand side, the South African value sector neutral and South African value not sector neutral over growth. the blue line and growth in this South African context has the same weighting to financials, to resources, to all the different South African gig sectors. And what you see is that value still would have underperformed growth since the global financial crisis. Whether you had neutralized or controlled for sectors, i.e. the blue line, or you hadn't, i.e. the green line, the journey of the blue line might have been smoother, but the destination was the same, value underperforming growth. And you see a similar story in US. And this is using the US value sector neutral, is based off MSCI's enhanced value, which is basically a sector neutral index, versus their traditional value, which is called US value index. And you see, relative to growth, it would have still underperformed in the long term. So the technology versus financials debate is not actually the issue, at least already from the slide and the evidence, it already makes me think it's not that, it's the stock selection. It's the companies that were picked in the value basket versus the companies that were picked in the growth basket. It wasn't as a result of these sectoral differences. So what's our view? Why has value underperformed? So we believe value has underperformed because of its elusive fundamentals. We believe that sustainable rallies are fueled by earnings growth, and basically it's a poor stock selection ability of value that got it where it is right now. So to give you a sense of why we believe that, let's look at one of the sustainable rallies that value did experience. So in the early 2000s, the value glory days, if you do an attribution to understand what made up the returns, so how much of it was explained by the dividend, by multiple expansion, and by EPS growth, what you see is a good portion of the annualized return during that period of 20% was due to earnings growth. So that's an annualized return of 20%. Obviously, if you compound, if you calculate cumulative, it becomes 140% over that period. And the bulk of that was earnings growth. Now, from the first slide that I showed you, you might think, well, value's just underperformed growth since the global financial crisis. So it's just been a growth always outperforming value. But it's important to remember value has tried to stage comebacks in these past 15 years. So for example, like I mentioned with the macro indicator, in 2009, coming out of the 2008 crisis, we saw value stage a comeback. In 2016, on the back of the Trump bump or the Trump trade, again, we saw value actually outperforming growth in that specific environment. And then more recently now in 2020. So what you see is a good portion of the returns in those environments were explained by ratings or by multiple expansion. In contrast to the sustainable rallies on the right, which is the value golden years that I've shown here on the right. So it's not to say value has not tried to come back. It's just that it has not sustained. It hasn't been a sustainable rally. So let's focus in on 2016 because it's very, very close to where we are right now. And there's also some major similarities between the 2016 Trump trade and where we are right now. So what's the similarities? There's been elections, Trump winning in 2016 and Biden now. So this risk on appetite was there in the Trump trade of 2016 also. What you see is after that rally in 2016, where value recorded 13%, it outperformed growth, if I remember well, by almost 16%. Growth actually was negative in 2016. 3 years later, it's been down 19%, whilst growth at the same time has been up 11%. And that's because of the growth component. So sustainable rallies have to be driven by earnings growth. A company, a sector, a style in the long term will have a sustainable rally if it's backed by the earnings fundamentals. So to summarize, value has been a poor stock selector versus growth. Again, here we're zooming into the South African market, same slide I showed before, because I think it's a very powerful slide. It has not been anything besides the stock selection ability of value that has made it underperform growth since 2009. So to conclude, we expect value to perform in the short term. And this is really on the back of this risk on recovery trade. Our indicators still forecasting recovery, and we think that that can persist for some time. And the inflation ability of value, inflation hedging ability of value over growth. But because value's underperformance since the global financial crisis has been because of its elusive fundamentals, not because of what interest rates have done in the long term or because of the sectoral differences, we find it unlikely that in the future that we will see a long-term rotation out of growth into value. But at the same time, it's not to say value investing is useless. I mean, in a multi-style setup, we definitely think there's an important component of having value in our portfolio, and it really talks to diversification. Value is the one style of investing which is lowly correlated to the rest of the styles of investing. And you have to think back to that slide where I showed that only value performs in a recovery environment. So there is merit in value from a diversification side. It's just that at the end of the day, for a long-term investor, it doesn't tend to pick the companies that provide good earnings growth in the future. So that's about it from my side on just summarizing quickly our findings.
Thank you very much, Anne. You're actually on the minute to 20 minutes, so good time management. I also see we are starting to get some questions in, so I'm gonna try and keep my questions to you to about 15-20 minutes, and then we can actually jump into the client questions. And I think that last point you made is something I took out of your presentation as well, around value only performing in one business cycle and underperforming in others. So the value trade in terms of everything on black when you go to the casino is quite a dangerous trade, but having nothing on value either is also a dangerous trade, because you will be found wanting in a certain business cycle. So I guess that's the one good thing that you need to acknowledge about value. Even though it's elusive to time and trapped in a certain business cycle, having it through the cycle, maybe longer term, also bodes well for you. But this morning when I prepared my questions for you and I looked at the title, given that I'm a big Bruce Springsteen fan, I couldn't help about thinking about his song. He's got a song called Glory Days, and it's basically how you reminisce about the old times, and when you get together with your friends, you just talk about that old varsity stories, old high school stories, and at the end of the song, he goes like, "I hope when I'm older, I'm not reliving the same stories again, but I'll probably will." And I guess for me, this is almost where we are with value now. We keep talking about this pre-GFC value. We've had in the article that you written, you write about the market exuberance and how people get caught up in the possibility of an economic recovery being the Kickstarter for value. And as you just shown, we've had these 3 failed starts where you've had a multiple expansion, but the earnings growth lacked, and then value just falls back in. And I guess the big question in the market now, given that the value rally has been going on for a while now, since, let's call it end of or middle Q3 last year. So we almost like 6 months into value performing decently. I guess the question is this time different? Which I guess you addressed to a large extent, but I think it's worth asking, are we seeing a different launch pad for value this time around, or is it again the same failure to launch environments that we've seen the last 3 times in recent years?
Sure, that's a good question. So what is different this time around is that we went into a recession as a result of a pandemic. So the recovery is coming out of something that was caused by a pandemic, and in recent times at least, the recoveries have in general been out of more financial crisis or something wrong in the financial system. So that's different. But what is similar is value performing in a recovery environment. And we see that being quite consistent. Whenever a recovery or a risk-on environment plays out in the market, that value tends to be bought up in that environment. So I would say, as much as you want to play into the fear that this time could be different, if you look at certain aspects, it's actually very not that different. And again, if you look back at 2016, I think there's a lot of similarities between the 2016 rally and the rally now. There was also a big stimulus. I mean, when Trump got elected, there was the corporate tax cuts that he made. Those tax cuts were almost like 2 trillion at that stage. And the aim was to boost the economy, get corporate expenditure up, and GDP and inflation didn't actually realize in that environment. But fears of inflation rising, etc., were similar then and now. So I think there's a lot of similarities from this kind of risk on environment in 2016, fear of inflation. In 2016, the commodity super cycle kind of talk, commodities rallying also happened in 2016. It's very similar to what is happening now. And if you look across the board, value rallying, it actually was consistent more in November with the breakthroughs of the vaccines, really boosting up this value trade in the market. So I would say, I don't think in certain senses is much different to the history, in the sense that it is to be expected that in a recovery environment, value risk on kind of investing tends to rally in the short term. But I don't think it's a longer term rotation than that, because eventually the companies will have to deliver or report on their earnings. And when they do, I don't think they will justify, match, or sustain the initial rally that we've seen happen now. But in the short term, yes, there's still a lot of more risk on environment happening, and clients wanting to invest in these kind of risky companies that value tends to invest in.
Yeah, which I think links into the next question I had, which is more to do with always sometimes confusing the definition of a style or a factor like value or growth, and we are only attaching a high level descriptor to it. So say value are cheap companies, or growth are earnings growth companies, or quality is good balance sheets. Or alternatively, we are attaching a sector at that point in time to a certain style. And we say, if in the US, for instance, if we talk growth, people think that it's tech. And if we talk value, we talk about financials. And I guess sometimes that skews the reason for an allocation to a factor, because you say, I want to get financial exposure, so let me go and buy a US value fund, instead of then going to buy a US financials fund. So how do you think practically, if you consider a lot of people on the call today are asset allocators, so they're either blending their own, for instance, SA equity block, and they're combining various managers. If they've got a view, how do you think about if you've got a view on a factor, to be precise, how do you express that view, and how do you then think about controlling for sector exposure when you express that view? Because I think, as you point out quite a lot of times, is you shouldn't confuse sector allocation with factor allocation, and you shouldn't let one drive the other one's performance. So how do you think about sector exposure when you construct something like a multi-factor fund?
Sure. So across all our style-based or factor-based funds, we control for risk of sectors. And this is because we think that you should be using style investing for what it's actually intended to do, which is stock selection. It is great at identifying the companies that will outperform in the future based on comparing it to its peers. So what I mean simplistically there is that within the financial sector, for example, we will look for the companies that have the best growth, best quality, best value relative to its peers in a sector, and tilt more to those companies than the companies that don't possess it. And by doing so, you really ramp up the style exposure in your portfolio. Versus when you apply it just blankly to the entire universe, where you're getting when you're getting a massive, actually, unintended risk coming through from these sectors. So in all our portfolios, we try to control for risk coming from sectors, so that we really bring the heart of style investing to the outcome of that the clients experience in the portfolios. So we think that neutralizing the sectors is very key in ensuring that you experience the style's performance and not unintended bets that can come through from the poor construction of these indices, if I can call it that.
So maybe just, I just want to make sure I understand correctly. So if you talk about neutralizing for sector exposure, like practically what do you mean?
Sure. So what that means is that, for example, a growth and quality, say, smart beta index fund would have the same weight to financials, to resources, to all the gig sectors as the market has, as a value index has. So same weighting to resources, same weighting to financials, same weighting to all the different sectors. The difference is the stocks it selects. So let's just use banks, for example, just as an example. That means if you're looking at it from a growth perspective, you are liking, say, the Capitex and the First Rands and disliking the Nedbanks and the ABSAs because they have better growth quality profile than their peers in the banking group. But your sector allocation is the same as the market and is same as a growth or a value index. So you've neutralized that unintended risk and you're using style investing for stock selection. And by doing that, you don't lose anything from style exposure. In fact, you maximize your style exposure and you use it to unlock the style premium.
Yeah, I think that's important to know that when you look at the universe of stocks and you apply a value lens, you use the same indicators across resources, banks, retailers, and you're just making a relative call within banks, retailers, and other sectors. So it's more a relative rating rather than a sector decision.
Yes, and I think that relative aspect is absolutely crucial because if you think about it, let's look at our market. I mean, if you want to buy some growth companies in our market, I mean, what are the growth companies? Probably just a couple of brand hedges. But when you look at it from a relative perspective, then what you're doing is you're expanding your universe. Your universe doesn't just become concentrated to a few rand hedge stocks. You're expanding the universe and saying, okay, from banks, I want the best growth and quality stocks from banks. I want the best growth and quality relative to its peers in resources, in financials, in consumer discretionary. So you're building up a more balanced portfolio, but still unlocking the style premium in the most efficient and best manner possible. So relative does not limit you, it expands your universe, and then you can really unlock that style premium in our market.
Cool. And I guess one of the questions I'm sure that's going to come is, are we too late for value in the rally? And I know you showed earlier macro model, which helps you have a view on which business cycle we're in, given that those factors are quite aligned to certain business cycles. But how do you think, again, given I think a lot of people on the call are allocating to various equity funds within let's say equity block, and they are either allowing the manager to perform discretion, or they are trying to make allocations around some other core to a certain style of bias, either in the traditional fundamental world in terms of value, or in the more index-based world in a value index indicator. So if you've got a view, so maybe firstly touch on how do you get a view from a procedural point of view? What things you look at to inform your view around factor performance in the near future? And then I guess secondly would be, how do you think about timing a factor exposure, like we said earlier, going everything on red or black in the casino versus tilting towards something you like? So maybe firstly, the indicators or things you look at to form a view on factor outlook. And then secondly, when you've got that outlook, how do you think about allocating to it? Do you go all in, or do you take a more measured approach?
Sure. So I'll start with the first part. So, I mean, this is the macro indicator. As I mentioned, it's purely data-driven, purely quantitative. Components that go into the macro indicator, almost everything that a macro specialist would look at. So we have inflation sub-indicators, growth sub-indicators, liquidity sub-indicators, and sentiment sub-indicators that at the end build up to this final call on what is this macroeconomic environment forecasting in the short term. So based on this, we're saying right now we are forecasting a recovery environment. We do still see there's some legs to this recovery call. And that's because if you look at the dispersion within the baskets between the value, growth and momentum, you're seeing that a lot more of the value companies are coming into the momentum basket. So that tends to peak 6 more months later. And also, if you draw similarities between Trump trade, you see that that lasted for 4 quarters, and we're probably 2 quarters in. So there's still some room for the people who have been too late to this value rally. But it's not a longer term rotation. History would inform us that max, it's been a 1-year rotation. And there's risk to this rotation. If there's some sort of hiccup on vaccine rollouts, there's things like that that could get this recovery forecast to go back into a contractionary environment. The discussion on tilting versus timing, as I mentioned, we use this indicator for tilting, not timing. And what that means is that our proposition to clients is that we will always be overweight or overexposed to the persistent drivers of returns in our market. So growth, quality at decent valuation. What we use this indicator for is to manage that tilt. Should we be most overweight growth, most overweight value, most overweight quality, for example? So we don't believe in using this for a 0 or 100 kind of decision, because we think that's very risky. But it comes down to what is the client's objective. If the client is sitting with a portfolio that's diversified from a name perspective with different asset managers in the portfolio, and they look through the analysis to see, well, actually, I've got 5 managers from different names. However, they all have a big value tilt. Then maybe the client wants to just buy into, for example, a STANLIB Smart Beta Growth and Quality Index. But if the client's objective is, I just want the best alpha out in the market, then they would achieve that objective in the long term by investing rather in a multi-style, systematic kind of equity fund, which blends the multiple styles in a fund. And it's no different to a fundamental active manager in the sense that its aim is to stock select to outperform the market in the long term. So it really comes down to a client objective on how to translate that into your portfolio. In this indicator is used in our systematic equity funds or our multi-style funds. And there our proposition is to always be overweight the persistent drivers of returns in our market. How we manage that overweight is on the basis of this indicator, but this is not the only indicator. It's just the indicator that a lot of clients have interest in. We also look at the valuation of the different styles relative to its history and relative to other styles. We also look at the trend behind the performance of the different styles, and then we look at the dispersion within the styles to inform a more aggregated, holistic view on what style will continue to outperform in the short term. So for those who are worried that they've missed out on this value rally, I think it still has some legs in the short term, especially with the recovery risk on environment staying as it is right now, but also the inflation fears coming from the policy and the stimulus packages. I think that will also play in favor for value in the short term. But again, to the title of this webinar, I don't see it being a return of value's glory days in the long term.
Right. So I guess what I'm getting out of that answer is if you want value exposure, go and pick a value fund. If you want multi-factor equity fund that looks at the market with various lenses that position at different times slightly differently, you pick a multi-factor fund, but you acknowledge that if value rallies, the multi-factor fund is going to underperform because it looks at other factors or other lenses at the equity market as well.
So yes, a multi-style fund, you should just think of it as no different to a fundamental active equity fund in the sense that it's stock selecting and the aim is to outperform the market in the long term. But in no means is a multi-style fund an all-weather fund. I mean, we need to appreciate each fund has a philosophy, and if you're being consistent at the philosophy, there are certain periods of time where it will struggle. And luckily for a multi-style fund, at least our evidence proves that the only time it really would struggle, and it's depending on its allocations also, is in a recovery environment, because it's really a value versus everything kind of environment that happens in a recovery environment. That's not to say that you haven't got any benefit from tilting to value. It's to say that the performance of the other components could bring it down in a recovery environment. But the positive is that, well, we don't spend much time in a recovery environment. Most of the time is actually spent in slowdowns and expansions. So if you look at it through the cycles and the long term, you see that having a more balanced approach, a multi-style approach to investing, majority of the time you will have market-beating returns in the long term. Recovery environments, less so, but always taking a balanced approach to investing is crucial.
Perfect. Thanks, Anne. I guess we're done with the section where you've got the easy questions now from me. So
I didn't think those were easy.
I'm going to hand over to Tracy, and maybe we can get some questions that were posted to Anne or myself.
Brilliant. Thanks, Vera. Thanks, Anne. Definitely a fascinating subject. So many great questions, actually difficult to know where to start. But I thought maybe, Anne, just to make it tangible and to give a bit of context, in your view, maybe you can give our audience just an idea of what you consider in the South African market to be value stocks. So some examples, 2 or 3 examples, versus growth stocks.
Okay. So in our funds, because we take a sector neutral approach, when I respond on what are the value companies, what are the growth companies, it's always in that kind of sector neutral framework. So what I mean is I'm going to say value companies in banks, value companies in consumer discretionary. That's how we respond to that question. And we think that by doing so, we don't reduce in any sense the style exposure of the portfolio. So in banks, for example, right now, the value companies are the ABSAs and the net banks, versus the growth and quality companies are the FirstRands and Capitec. Now, if you look at it in discretionary retail, Clicks is a great quality company. It's great growth prospects, but it's expensive. So it's not a value company. So it really depends on which sector, but across the different sectors, what we're trying to do is tilt to the companies or weight the companies that have the better growth quality at decent valuation and avoid the companies that don't tick those boxes. So right now in banks, for example, the value companies are the ABSAs and the net banks, and you see those companies got sold off massively in the COVID crisis in favor of the growth Capitec and FirstRand. So overall, the entire banking sector went down. But when you look at it on a relative play, you see that the net banks and ABSAs went down more than the FirstRands and the Capitec.
Sort of following on from that in a practical sense, Wehmeyer or Anne, either of you, is the question, is the SA market too concentrated with too few companies to build a factor portfolio compared to obviously the US with a much larger universe to choose from? Yes, that's always sort of the skeptical side of it is can we get that specific in our South African market given liquidity constraints and sort of size of the market?
I'll take that, Wehmeyer, unless you have any particular angle.
Preference.
And luckily, I have a slide in the appendix that can talk to that. No, I do not think that the concentration and the depth or the breadth of our market limits style investing at all in the South African market. But I can appreciate that question because, again, let's just use the growth aspect. If you're looking for just pure growth in our market, there's only a couple of rand hedge stocks. But now, if you rather change your mindset from absolute to relative and look across the different sectors and pick the best growth companies from the different sectors, then what happens is you expand the universe instead of having that very narrow universe. Then you are going and picking the best growth companies within banks, the best growth companies in retailers, in insurers, etc. And by doing so, you are going overweight the companies who are relative to their peers, better growth, better quality, for example. And this slide talks to that point in that, so this compares two smart beta indices. So the blue is our STANLIB smart beta index, and the black is a S&P off-the-shelf smart beta index. Now, the major difference between the two, granted there's some small definitions of what the smart beta is defined by, the major other difference is that our indexes are sector neutral, so same weight to financials as the benchmark or as the market cap index, whereas the S&P off-the-shelf index doesn't neutralize for sector. And what you need to focus in on is this first column here. By sector neutralizing, you don't reduce your style exposure, you actually ramp up quite significantly your style exposure in your portfolio. So it's not actually a limitation of our universe that there's few counters, because if you change your mindset from an absolute to a relative within each sector concept, then you actually unleash style investing to a bigger magnitude than in just an absolute context. So no, I don't think having only 160 companies in the market cap index, for example, and a very concentrated index limits us in any sense, because we are looking for the relatively better growth, quality, value companies in the respective sectors.
That makes sense. I guess that probably to Graham's question, where he's asking, please can you explain what you meant by it's the stock selection of value that has caused it to underperform? Yep. And he's because isn't it the sector in general that's underperformed?
Sure. So this is why I say it is the stock selection and not the sector aspect that has resulted in value underperforming growth, and this is in South Africa. So I know this might be a very hard graph to understand, but simply what it says, the fact that this is down relative to one line, to the line that is horizontal at 1, it means that both the blue and the green line have underperformed growth. The blue line has the same weighting to the different sectors as growth had. The only difference was it selected stocks different to the growth index. So if you had completely neutralized for sectors and had the same sector weighting in a value portfolio and a growth portfolio, but the only difference is the stocks that the value portfolio decided to like versus the stocks that the growth portfolio decided to like, you still see that in the long term, value had underperformed growth. So it was not because of the sector allocations, because there's no difference in the sector allocations in this slide here. The only difference was the stocks it selected in the value portfolio versus the stocks that were selected in the growth portfolio. So this is why I say value has been a poor stock selected. It selected companies that eventually have not delivered on improved earnings that matched, sustained, or justified the initial rally that they saw.
And I guess, and it's that, I guess, very single dimension of value that has caught it falling short. Like by just looking at the cheapness, it doesn't really tell you a lot about its prospects, other than it's cheap.
I don't know if there's anything else you think we should unpack on your side. Otherwise, sort of an expansion on one of the questions you asked, Wehmeyer, but could we be confusing the value growth argument with the structural change in economies, i.e. tech-driven, which skews obviously to the old or to growth, versus more older stock in the economy? And how do you guard against your value call being wrong?
Sure. So what I hear from the question is it the kind of long-term, or since GFC, the low interest rates that have been playing out in our market, and that working against financial stocks in the long term? And is it that? So it's basically both of these arguments combined. It's the low interest rates, and low interest rates have been a negative for financial companies. So it's also a sector difference that has resulted in value underperforming. Now, we've shown both aspects of this, this commonly cited difference on why value has underperformed growth. And we say, no, it's not actually the low interest rate environment. And it's not the sectoral differences, because when you neutralize for sectors, you still see both in the US and in South Africa, value still underperforming growth in the long term. That's not to say in the short term, if there are changes that have a connection to expectations, that you don't see short-term dislocations between value and growth. But in the long term, and it's a really hard concept I can appreciate for clients to understand, because the narrative has been so strong on this, that it's actually just a tech versus the boring financials. But when you neutralize both in US and in South Africa, you see that again, value still has underperformed growth. And that's because it did not pick the companies that later on provided profits or earnings that sustained the initial rally. It's about the profit, but the lack of its ability to forecast or to select the companies that will be profitable going forward. It's stock selection ability that has lacked. It's not the sector differences that have made it land where it is. I hope that answers the question.
Maybe, and just to add on to that, I think sometimes it's thought of value changing the way it looks at the universe as the market changes. But it actually looks at the universe. And when I say universe, I mean your starting index, and let's use South Africa, 160 stocks. It looks the same at those stocks today as what it did in 2008. The only thing that has changed is the information. And what I mean with it still looks at traditional valuation matrices like P's and dividend yields. It just applies it on a new set of information. And the output from that set of information might mean that, as you said earlier, financials are screening cheaply, but you are applying it within the sector. So it actually, from a sectorial point of view, it just changes based on the new information that you feed into that lens almost.
So if I understood you correctly, actually Brandon was one of the first questions that came along. And I think it follows on to that. So he's saying, will the value trade not move into the momentum trade if indeed we do go into an expansion, i.e. giving value legs for longer?
Sure, that's a good question. Let me just check if I have a slide that, yeah. So this slide, basically what it's saying is that values rotation is past the beginning stages. So you are seeing a correlation pick up between value and momentum. That being said, what you see is that generally, once it's peaked and it's halfway through that line, it tends to reverse back in favor of the growth and quality companies. So yes, there's an argument that now momentum stocks, the momentum type of investing will select value companies. But if you look through time, that's the blue line here. Even though it's gotten correlated with momentum, it has never been positively related to momentum. And that just talks to the fact that these trends don't persist with value. So values correlation recently with momentum has come up, but this is as far back as 1996. It's never gotten significantly positive the way it is with growth. And that tells me independently that it's the poor stock selection ability of value that this correlation with momentum doesn't ever go above the zero line. Does that answer the question?
And so am I right in saying at that handover phase between a recovery and expansion, you might see some value stocks moving into the momentum bucket momentarily, but as soon as they disappoint, they're going to fall out of that bucket.
Exactly.
That doesn't mean they sustainably shift into that, let's call it the expansion momentum bucket. They might at the crossover do it, but then fall back again.
Yes. So there'll be more counters in the momentum basket than historically, but then comes the most important aspect of a sustainable rally: the companies reporting and them delivering on earnings that match up to a market's expectations. And that's where value falls flat.
As I say, there were so many excellent questions, some very technical ones, which I won't try and attempt because I
love the technical ones.
Exactly. I thought Anne may like them and I'll probably just ask them incorrectly. So maybe on those questions, we'll get back to you individually. And Anne, I'm sure, would love to take the time to chat to you or to respond directly. So we promise to do that. Maybe Anne, if you want to take a few minutes just to wrap up, and then we will definitely be posting your article on the stanlib.com website. So that's available for a full read through. and then your CPD certificates will definitely follow. And thank you email with the presentation should be out shortly as well. You want to wrap up? Thank you.
Sure. Thanks, Tracy. So in the short term, we think that value will outperform growth. And there's legs to this recovery trade, really on the back of this risk-on environment. And we're seeing this recovery environment play out at least for the short term. And also this inflationary environment where there's a lot of fears for inflation rising will also be supportive for value. So that really anchors our short-term view. But in the long term, we do not see this as a more secular, longer-term rotation out of growth into value, because value is just not able to consistently identify the companies that will eventually deliver on earnings. So sustainable rallies are fueled by earnings growth. That's where value struggles. So we don't think a longer term rotation is likely for value, but we do appreciate that diversification is absolutely essential. So value does have an important component in any multi-style portfolio because it does provide that diversification benefit for the client's investment outcome. But to summarize, in the short term, go for value. In the long term, don't have much faith that this is the return of value's glory days. Thanks.
Brilliant. Thanks. And Wehmeyer, anything from your side?
Yeah, I guess the only thing I would want to say is, as you can see, Anne is quite passionate about these things, and so is the rest of the team. So I would almost encourage engagement from the client side. So as Tracy said, we're gonna get back to everybody on the questions, because there's quite a lot to answer. But if there are any additional questions or you'd like to debate these things further, more than happy for you to get in contact with STANLIB Medium, and they'll set up some time for us to have a chat. So yeah, that's just an open invite from our side.
Brilliant. Thanks, everyone. Well, again, thank you for joining us and spending the afternoon with us. And we look forward to hearing from you and seeing you again soon.